Hello people, Dr. Wang is here. In this video, I'm going to teach you how to do the second assignment. So in the second assignment, it covers a few chapters. The first question is from chapter 7 about corporate bond. The second question is from chapter 9, which is about stocks. The third question is about risk and return analysis for the entire portfolio that is made of two stocks, stock A and stock B. The third question comes from chapter 8. And then question number 4 is from chapter 10, weighted average cost of capital. So let me just brief you with these questions and how exactly you're gonna pursue doing it. So let me just move enough space right here, and we will see that for the bond question, you are an investor and you are thinking to invest in a company, and that company issues a bond, which is a semi-annual, and you have certain maturities and a coupon rate. So the first question here is, what is your required rate return? Your required return is already given, that's 8%. And what is the highest price you would be willing to pay? So right here, you have a bond price, which is $912, but that is not the answer to this question, because you are looking for your price and you are separating yourself from the rest of the market. And the market price is $912, but you need to know what would be the price you are willing to pay as one of the individual investors. So in order to get your price, you should use the present value function, okay, of Excel or the calculator. So based on that, you need to find your future value of the bond, the payment, number of periods, and also the required rate return. So the bottom line is you always find the four components and solve for the fifth, which is the present value. So if you look at the future value, it is going to be $1,000, as is always true if the bond naturally matures. And the payment is based on the coupon rate, and it will be multiplied by the 1,000 face value. Okay. However, this is a semi-annual bond, and you're gonna do something differently because each payment for each period is half of the annual coupon. So you have to divide the whole thing by 2. And how many periods do you have? You have 8 years in total. However, that's not the total periods, so 8 need to be multiplied by 2. So in total, that's 16 semi-annual periods for the bond existence. And for the interest rate, that's 8%, which is your required rate of return. You're going to use that to discount all the cash flows, including the periodical coupons and the face value, one-time face value. And you should know that this 8% lasts for the entire year. So for each semi-annual period or for each 6 months is half of the 8%, so which is 4%. And based on these 4 factors, you would be able to figure out your own price. And it's not surprising that your price is different from the market price. So what's the catch here? If your price is less than the market price, so basically you think that the bond is worth less than what it's selling for. Imagine you're about to buy the bond and you think it's worth like $800, but it's selling for $900. Would you like to pay the market $900 for the bond when you think it's only worth $800? So you just don't buy it, right? But alternatively, if your price is greater than the market price, so let's say if you think the bond is worth $1,000, whereas it's only sold for $900. So I think that's a good deal for you to buy it, right? So you only pay $900 for something that is worth $1,000 to you. So you would buy the bond. Okay. So the thing is, you have to separate yourself from the rest of the market. Okay. And the question 2 is about the yield to maturity. And the yield to maturity, another name for it is the market required rate of return, or the return required by the entire market for this kind of bond. As I mentioned in other videos, the required rate of return is truly determined by the riskiness of the bond. Okay, if the bond is more risky, then the required rate of return, okay, should be higher. So how do you get the market required rate of return, aka yield to maturity. So this is about solving for the interest rate, okay, solving for the interest rate. And you should know all the other 4 factors to put in your calculator. You should have present value. What is your present value? Clearly, that's the market price that's given. You should have the payment, which is the same. And you also have the future value, which is also the same as what you did for the question number A, because the payment and the face value or the future value is in a bond covenant. It's already determined. This will not change. And also for the number of periods, it's also the same. Okay, so the 4 factors here are already provided. So your job is to solve for the 5th, which is the interest rate. And don't forget about the frequency, which is twice a year. So you will find the yield to maturity. This has to be an annualized number, okay, or an annual rate. Some of you may use third method and find the semi-annual interest. So how do you analyze it? So if you have a 6-month rate or semi-annual rate, you need to multiply it by 2 to get the annual rate, okay? And the yield to maturity is an annual rate. Okay, that's how I dissect this one. And for question C, the bond is got called back in 3 years with a call premium of 5%. What is the yield to call? And yield to call, well, again, is another market rate. Okay, so the yield to call here is something you are solving for. And again, you're gonna find all the other 4 factors, so you can solve for the 5th. That's how we do the time value of money questions. So the current price or the present value is the market price, and the payment is the same. However, the future value is not the same, because when the bond is called back, not only does the investors get the face value, but also in addition 5% call premium. Okay. And for the number of periods is not same anymore, because the bond does not exist for 8 years. Instead, it exists for 3 years times the frequency. So you should know how many period of bond it got paid off from the date it got issued to the date it got called back. And don't forget to analyze it. Okay, so that's for question number 1. Question number 2 is about stock valuation. So these are the terms. So the terms is basically telling you the growth rate of the bond is %. Okay, and the required rate of return is 12%. So the growth rate is to compound the to compound the dividend. Okay, to compound the dividends, and the required rate of return is to discount all the cash flows. All right, so what do you do here? So you're gonna use the discount cash flow model. Okay, and the price now should be the first period dividend, let's say dividend 1, divided by the required return minus G. So the formulas are already addressed in chapter 9. So you have G, you have R, but you should find out dividend 1 by yourself. Do you have dividend 1? Not exactly, because what is provided here is dividend 0, which is $1.2. That is the dividend just got paid, and you're not receiving that. If you try to find the price now, the first dividend should be dividend 1, right? So imagine, picture yourself just bought this stock, and you're not getting dividend 0 because that's already paid to somebody else from whom you buy the stock from. And the first cash flow you receive from this stock is dividend 1. Okay, how do you get dividend 1? Well, that's easy. That's dividend 0 times 1 plus the growth rate. And for the second part, so we change our assumptions. You have a 2-stage growth rate. So it's about 2-stage growth. And the first stage provides a growth rate G1. It equals to 20%. It lasts for 3 years. Okay. And then the second growth rate is 8%. And that's going to last forever from the fourth year till infinity. Okay, just say till judgment day. Okay. All right. So what do we do here? Well, if you look for chapter 9, that tells you exactly the steps you're gonna do here. And I will not do too much repetition. I'm just telling you the first step is to get a dividend 1, dividend 2, dividend 3, and a dividend 4. So it's always one dividend after the first stage, given that the first stage lasts for 3 years. And then you find a price 3 based on dividend 4 and the growth rate of 2 and the required rate of return. All right, and the third stage is to get the net present value based on 3 years of cash flow. Okay, so your cash flow 1 is your dividend 1, your cash flow 2 is your dividend 2, and then your cash flow 3. Okay, that's the touchy part. So at the end of the third year, you sold the stock, right? That's how it works. Assume you sold the stock. If that happens, then the cash flow you're going to receive is the price 3 plus the dividend 3. Okay, so the NPV based on these 3 years of cash flow will be your final answer for this question. Okay, for question number 3 here is about solving for the expected return, standard deviation, and coefficient of variation for 3 investment: stock A, stock B, and a portfolio made of both. Okay, so I want you to look at the portfolio management project. It's the Excel project on the canvas. As for each of the assignment on this Excel project, I have posted a video or a series of videos for each Excel project. So all you need to do is replication. So just to go for that Excel project and have it finished, and then you would be able to calculate these things using Excel. Okay, so do that Excel project first. Okay, do this first, so you know how to do the calculations. And for the portfolio, you need to get the portfolio return, okay, from different years, from 2005 to 2009, right? And you're gonna create a whole new column right here called portfolio returns, and then you will find the portfolio return for each of the years. So the portfolio return basically is 20% of A's weight times stock A's return plus 80% of a stock B's weight times the return of a B. And you're gonna do it for all 5 years. And so you will have 5 portfolio returns. And then you're gonna do the same as what you did for A, what you did for B to get the expected return, standard deviation, and coefficient variation. All right, and then to minimize the coefficient variation of the portfolio, how much weight should you be assigned for stock A? So then you're gonna rely on, let me just scroll down a little bit. Okay, oops. You're gonna rely on the solver function of Excel, okay, to do the optimization problem, okay, to optimize. And once again, that requires you to finish that Excel project first. That tells you all the details to work on the solver function of Excel, okay? And your goal here is to minimize the coefficient variation of the portfolio, okay? So the minimum CV basically indicates you have the best return combination. Well, you guarantee a certain return and the risk is minimized. Okay, question number 4 is about WACC. You get all these pieces of information and you're gonna dissect all of them and put them in the right place. If you check the WACC formula, that basically requires you to get the risk of a debt times the cost of debt, okay, which is return of a debt plus, oh sorry, you need to do 1 minus tax rate, okay, plus the weight of equity times the return of equity. Okay, so if you read each piece of information, then you will see that there's no preferred equity. So instead of having 1, 2, 3 components, you only have 2 components. So you don't have another one, another weight, another return for preferred. Okay, the company debt is financed through corporate bond, and the yield to maturity is 8%. So basically, the cost of debt is the required return of the bond by the market, and that is the yield to maturity, which is already given. Number 3, the company's common stock has a return of 12%. If the company pays 12% to its stock investors, that basically means the cost to raise equity is 12%. Okay, so that's the cost of capital for equity. And then you have a tax rate there, and the tax rate should be plugged in right here. And then you need to work on the weight of a debt and weight of equity. Okay, and you should know that they are all in percentage. Don't ever forget this. They are all in percentage. So how to get the percentage? You know, they all add up to, both of these terms all add up to 100%. And what's the weight of each of them? So you should know first what the total capital is. Okay, the total capital comes from 900 units of bond, $900 per bond and 1 million bonds. So you should use the product of $900 and 1 million units. So that's how much money the company collected from issuing bond. And then you will have common equity, each is at $110, and there are 10 millions of stocks. So the product comes from, will give you the total market value of common equity. So it's about the value of bond plus the value of equity. All right, and each of the values will take a product. You're going to use the price per unit times the number of units, and then you solve for percentage. Okay, then solve for percentage weight. Okay, so that's how you do this problem.